In this video, we're going to create a few new scenarios that we can compare back with this original, where Justin is spending $48,000 in retirement and he's running into a shortfall at age 93. What we're going to do first is rename this scenario. This will be baseline spending of $48,000 a year. Then we're going to copy this scenario. And in the new version, we're going to save more money before retirement. So this can be scenario 2 with additional savings. Now, when Justin's mortgage is paid off by the time he's 61 years old, right now what's happening is there's no further mortgage payments. And looking at the base expenses, we can see that these have jumped up because he's just spending that money that he previously had been saving into the mortgage. Now we're going to save that money into the non-registered account. So we'll save $5,000 in this first year and then the full $10,800 until he's 64. Also, the rate of return here is just 1% because we have 100% cash. But if he's going to be saving that money, we'll adjust the asset allocation to a 40%, 60% split, and then run the scenario. So this asset allocation changes in that year and going forward. So if I scroll down to the bottom, I can see now that my shortfall is starting at age 96. So things are a little bit better for Justin, but let's look at the comparison. So up at the top, I can choose compare scenario, select which scenarios to compare, and just as a tip, you could just compare one scenario if you wanted to, and you would just have the information for one only. But here we've got 2 scenarios and then a difference column. So in this scenario comparison, you have a lot of different options. You can choose summaries, which is what we're looking at right now. So this is a variety of metrics that you can select which ones you would like to show or not show. So here we have this lifetime corporate tax, which is not applicable. So I'll just deselect that one and then again, select show selected metrics, and now that item is missing from my table. We have goal progress. 90% of the goal is reached with scenario 1 and 94% with scenario 2. So here we have a difference of 4%. So we're still not reaching the goal, but we do see some of the differences in that the final estate is better off by $194,000 at age 100. So at the top, we could select a different age to compare it. Or we can take a look at trends. So if I select trends, this is going to be a comparison over time. And again, one of the top comparisons that we find is the personal estate after tax. And so with scenario 2 being the blue one, that is a better, higher estate after tax for most years here, starting after about age 61. So we can look at another scenario. What if we were to delay taking CPP? So that's another option. So we can copy this scenario and make a third case. So this will be delay CPP as well as the additional savings. So to delay that government benefits, we can just select the government benefits header here, go right to scenario setup, and I'll change the age to 70. And we'll see that once I click away, this updates for me automatically. Come back to the planning page, and without CPP benefits, Justin's going to have to be taking more money from his own assets. There is a small RSP withdrawal that's happening, even though my withdrawal order is non-registered TFSA registered. This is happening because SNAP is taking that money out tax-free because it would make sense to do so. There's no taxes here. So Justin is getting that money tax-free, but perhaps he doesn't want to have 0 taxes for this period of time, and instead let's smooth out the taxes. So we can do that by selecting the earlier RIF conversion age. So if I go back to the financial assets, RSP and RIF, and we change this age to 64 to convert, that means that the RIF income will start at age 65. And back on the planning page, we will hover mouse over the withdrawals, and this little pop-up shows me that it is taking the minimum withdrawals in these earlier years. Now the marginal tax rate is staying at 19.05% throughout. So how does this compare to our other scenarios? Well, let's take a look. Compare scenarios. We've added the third case. And in this table, which you can compare up to 5 scenarios in this table, we no longer have a difference column, but we can just compare each scenario for all of these different metrics. So for example, coming right down to the estate after tax, in this case, we end up with a higher estate after tax at age 100. We're reaching 104% of Justin's goal, so we're surpassing his goal. And if we take a look at the trends, we can see over time how these scenarios compare. And again, I'll come back down to the estate after tax. So here we go, down here. And now with the third scenario being this teal one, that is the highest final estate at age 100. And it diverges quite a bit here after, age 81-ish. And lastly, we can take a look at, on the planning page itself, you can see the total tax for each scenario individually. So here it's broken up with the federal and provincial taxes over the years. Or in that scenario comparison, we also have the option to see the lifetime taxes paid, because that is another comparison that people would like to see. Interesting here, the lifetime personal tax is highest in scenario 3, but they still have the highest final estate after tax as well. And if you'd like to present this information to your client, you can export this table or the trends and also print it. And we'll talk a little bit more about our client-friendly report and the summaries that are available. But in our next video, we're going to go into automated recommendations.